Good morning everyone, welcome back to Acorn FX. Today we're going to talk about different types of investments. To start with, let's just talk about trading setups, how many monitors you need, and what news sites you should sign up for. I'd recommend if you're just starting off, one monitor is adequate. And news sites, I'd say you use your Financial Times, Telegraph, BBC News, them sort of things, Bloomberg. And as you develop further and you require more analysis, more in-depth information, then you can build up on the number of monitors you have. But I think to start with, one monitor is sufficient for your requirements. Let's start off with FOREX, the most basic and most common one we'll be discussing today and going forward. And essentially it's the buying of one currency against another. So in the example here given on screen, we're looking at AUD versus USD. So it'd be how many US dollars can we buy for one Australian dollar. So as you can see, the prices are going up and down throughout, and this was constant pretty much all the time, 5 days a week. So if we look at the yellow arrow, if we bought it at the stock at the yellow arrow, we saw it greatly appreciated. And if we'd use a call option at this point, we'd be in the money because we'd called it when the price was circa $0.7854 for one Australian dollar, and the price would appreciate to roughly $0.7855, which would be reflected in our profit margin. And conversely, if we look at the white arrow where we can see the price dropping, if at that point we'd use a put option, then similarly we'd be in the money. And that's essentially how the Forex market works. We're trading as to whether we feel the price would appreciate or depreciate, and as a result our profitability would then reflect this. If we got it right, then we can see on the right hand side there's the amount, so pound all the way up to, I believe, to £10,000, multipliers, which we'll get onto a little bit later, and auto closing function. This is a very good function, is what I'd always recommend someone have. It's what they call a stopgap. So if the price fell and moved against you by a certain percentage, the trade will automatically close. It's very useful to avoid large losses, but can never eradicate all losses because there's always risks associated with Forex trading. So we've discussed what is the different currency pairs. How much can I earn? That is the $1,000,000 question. How much can you earn depends on a number of different factors: your skill, your experience, your stake at the beginning, your appetite to risk. So I don't think there's any way that we can say how much somebody can or cannot earn in a given period. How do I know when to call or put? This is the next biggest question. I'll say this is the $750,000 question. It's really a case of watching the graphs, understanding the graphs, what's causing the mechanics behind these changes, noting any points of sort of interest, support, resistance, and then how you feel given the above indications, how you think the market will go. And there's never a sure way to know which way the market's going to go, to call or put. There's lots of different programs, strategies, guides online, but I don't think there's much value in them as such, really, because there's no way that anyone can beat the market. It's such a huge global market. There's not one strategy, one trading method that is going to beat the market. Let's move on to binary options. I think binary options are very popular at the moment, and it's called a high-low option. So it's a fixed return option. So essentially, a fixed return option means if the market moves in favor of yourself, you have a fixed return. So for example, in this instance on here, we have the amount of £1, profit is 70 pence. So if you chose the right option, so call or put, and you get the £1 back, plus you get 70%, so 70 pence back. So it's great in the sense that you know how much you're going to get back upon a successful trade. However, if the market moves against you, you lose the full stakes of the £1. So essentially, binary options is you either call or you put. So for example, looking at the white arrow here on the market, if we'd done a put option because we believed the market was going to go down, and the yellow marking was essentially the closing price. If you went to there, as you can see, the price has dropped of the currency. As such, we would be in the money. So we'd get our £1 stake plus our 70% return, which is always what we're looking for. Once again, how much can I earn from binary trading, and how do I know when to call or put? Say, go back to what I spoke about in the Forex. How much can you earn depends on a multitude of different factors: your experience, your knowledge, your risk appetite, your stake. How do I know when to call or put? Once again, do your own analysis. You'd have an idea of whether you feel the market is going up or down, and as a result, this would determine whether you would call or put. Now, our next one is CFDs. CFDs, also known as contracts of difference. They're a derivative trading method, and they provide opportunities to trade on the price using multipliers. What that means is essentially we can leverage our trade. So if we put £1 in, the multiplier in this instance is 25 times, apologies. So I mean our returns would be similar to if we'd invested £25. So essentially with a CFD position, you would enter the amount you'd like to enter the trade, the multiplier, so it could even be up to 100 times, and auto close. So in this instance, if we bought at the white arrow, see the price continues to ascend, then we'd be in the money, and as such, the profits we would make would be multiplied by 25, as though we'd stake £25. It's very interesting. So how do they work? CFDs work by essentially leveraging money. So what that means is if you only stake £1, the company may stake, say, £25 on your behalf, and as such, you could make more money. So you can make more money? Absolutely. Your profits will be multiplied by the multiplier that you have in place. So why not I always use CFDs? Mainly because your losses would also be multiplied 25 times. So if you staked £1 at a multiplier of 25 and the market moved against you, you would lose £25. So essentially it does carry a high level of risk. I would ask people to utilize caution in these